Good afternoon, everyone, and welcome to our webinar series. I'm George Ozude of Time Health Capital, alongside my co-host, Bayo Fasano of Dr. Breathe Easy Capital. Today, we have a great webinar to present to our physician and professional community, and it's on a very important topic, taxes and tax strategy planning, which can be a complex and overwhelming subject for households and businesses. But with a well-planned strategy, you can minimize your burden and your liability. So we have Mike Pine tonight. He's a respected CPA who is an authority on tax strategies for passive income investors. And I have known Mike as a tax mentor in my investor mentoring club. So I've had the opportunity to hear him share his expertise on monthly group education calls for over a year now. He's an author and the founding partner of Pine and Company CPAs based out of Keller, Texas, and his experience as a tax professional spans over 2 decades. So we are very excited to welcome him tonight to the webinar and look forward to all the information that he will be sharing. I'll let you take it away, Mike.
Thank you. Thank you very much for having us here. And I'm excited to talk tax. I say that honestly, knowing that most people hate taxes, don't want to think about taxes, and they just see them as this evil thing. But in reality, if you look at taxes with the right perspective, they can be an incredible tool to help you build your financial freedom. You can either choose to take advantage of the tax code, or you can choose to be a victim to it. And I'm hoping that through opportunities like this to share with the public, great opportunities in the tax law, that starts to change, and more people take advantage of the tax code and stop being a victim to it. There's no reason to be a victim to the tax code. Let's start off with sharing my PowerPoint here. So George asked me to come up with some proactive tax strategy and planning tips for 2023. These aren't just 2023. Most of these strategies and advice is probably going to be good and evergreen for most of your tax life. Tax law is always changing. Anytime it changes, usually it changes with taxes being raised. That's not always the case, but even when taxes are raised, anytime the tax law has changed, there's always underlying opportunities in the tax code. Our Congress and our politicians, basically our society, comes together and tries to decide how to improve our economy and the well-being of the people that live in it. Our tax code is full. Less than 0.5% of our tax code actually includes the levying or assessment of tax. More than 99.5% of the tax code includes incentives that our society has come together and agreed will help improve our economy, help lift a rising tide raises all ships, and help incentivize things like affordable housing. In that tax code, they offer those incentives through monetary value, through tax savings and tax optimization ability. Using that as a tool when you're considering investing, when you're considering business, can add a huge ROI in your world. So let's go over some of the basics. There's three basic avenues in reducing your income tax. Obviously, tax deductions, which we're going to go over some of them. Then there's tax credits. And then there's also investing in tax advantaged or tax optimized investments or income streams. Quick differentiation between tax deductions and tax credits. Tax credits are great. They reduce your taxes dollar for dollar. You get a $1,000 tax credit, it's going to reduce your taxes by $1,000. If you have a $1,000 tax deduction, and let's say you're paying tax at a 37% federal marginal income tax rate, a $1,000 deduction is only going to decrease your tax by $370. So tax credits are always better if you can get them, and we'll talk about some of those out here in a little bit. And then again, tax optimized investments. We're going to go over some examples of that as well. And there's ones that offer you tax benefits in reducing your ordinary income, your W-2 wages or 1099 contractor payments. And then there's others that just offer you tax advantaged income streams that are either no tax or low tax. And in the best of both worlds, you get both of those in some tax advantaged investments. Before we get into any of that, I think it's important to understand the way IRS looks at income. They see 3 buckets of income. They make you report it and record it in 3 different buckets, separate buckets. You've got your active income bucket. That includes your wages, your W-2s, your 1099s, any pension payments that you're receiving. If you're a real estate professional, we'll get into that in a little more detail. Any real estate income you have would be considered active, or any real estate loss would be considered active. Any business you own that you materially participate in or any business that you have ownership in. You don't have to own the whole thing. You can be a partner, an LLC member. As long as you materially participate, which I'll get into that detail a little bit later, that is an active income or an active loss. Then you have passive income, which generally speaking is investment in real estate. If you're not a real estate professional, investments where you receive K1s, investments that you truly are passive. You might have been active in at one point, 5-6 years later, you're still getting earnouts. It switches to passive, generally speaking. Then you have portfolio income. That includes your bank interest, capital gains and losses, your dividends. The important thing to note there is any losses in the portfolio income area, like your capital loss, you cannot use them to offset your active income or even your passive income. You can only use those losses to offset portfolio income. Same thing with passive income. You can't use passive losses to offset capital gains. You can't use passive losses to offset your W-2 income. Active losses, on the other hand, can offset or reduce your taxable income from all three buckets, from the active bucket, from the passive bucket, from the portfolio bucket. Any losses that you can get, tax losses, hopefully not actual cash or economic losses, but tax losses that you can have designated as active legitimately can reduce all of your taxable income or eliminate it. Our previous president, the last one we had, according to the New York Times, he hasn't paid any taxes in something like 20 years. And I highly suspect it's because he was a real estate professional and he was able to take depreciation and offset all of his income, assuming he made any income, probably did, but didn't pay taxes. And that's legitimate. And that's the main driving factor for that in our tax code is affordable housing. We know it's a problem. And it's the reason they offer these tax benefits and opportunities in the real estate world is to improve affordable housing. There's some other ones that we're going to get to in the tax credit section a little bit too. But again, remember, any passive income or portfolio income, if you get a tax loss allocated to you through either of those buckets, it can't offset your active income. You have to track each bucket separately. So common deductions, some of them that you can take against active income. I think we all are probably familiar with your itemized deductions. Any charitable contributions, your mortgage interest on your primary or secondary residence, you get to deduct that as an itemized deduction. State and local taxes, your real estate property tax, your state income tax. You used to be able to deduct all of it. Now you can only deduct up to $10,000 when you combine them all. That's going to expire. It's scheduled to expire in 2026. We'll see if it actually does. Any active losses you have, you run a business. And one of our biggest growing client sectors is people running Airbnb or short-term rentals, vacation rentals. If they materially participate in running one of those businesses, and as long as, I'll get more in deep detail, as long as it qualifies under the hurdles it's supposed to qualify under, that's a business that they're materially participating. And if they generate a loss with a lot of accelerated depreciation, that can offset their active income, their W-2 income, their business income. And we'll talk more about oil and gas, but oil and gas has a special carve out in the tax code. Even though you might be a passive investor in a lot of oil and gas investments, as long as you don't have liability protection, as long as you're not invested through an LLC or some other type of contractual liability protection vehicle, the losses, the tax losses, intangible drilling costs, the depreciation or bonus depreciation that comes through an oil and gas investment is considered an active loss just because of the carve out in Internal Revenue Code at 469. Now let's talk about real estate professional designation and how to qualify for it. And before I explain the qualifications, the reason I'm talking about it is the promised land in the tax world. Of all of our clients, the ones that pay the least amount of taxes as an effective tax rate are the ones who qualify for real estate professional. If you qualify as a real estate professional, very good chance that any depreciation you can have allocated to you, whether it's through syndications, through outright ownership of single family or quadplexes, all of that depreciation, or commercial property, all that depreciation can offset your active income. One thing to think about, especially with physicians, I can't count anymore on both my hands and my toes how many physicians we've had where their spouse decided to become a real estate professional. As long as you're married, legally married before the end of the year, if one spouse qualifies for real estate professional, then both spouses get the benefit of real estate professional designation. In order for one spouse or one person to qualify as a real estate professional, there's two hurdles you have to hit. You have to hit both of them. One is you have to spend at least 750 hours a year in that tax year on real estate professional activities. That's not that hard to do. That's just under 15 hours a week. It's very achievable. But the second hurdle is what knocks most of us out of it, knocks me out from being able to do it. You have to spend more time on real estate professional activities than all of your other combined professional time. So I spend about 3,000 hours a year in our practice as operating as a CPA. I am not going to be able to find, there's not enough hours in the year to get more than 3,000 hours of real estate professional designation. However, if my wife is working as a realtor, you can call it a hobby realtor, and only listing to friends and family, and just doing select listings, and she's not doing any other professional activity, she would argue, and I would agree with her, that she works her tail off raising our kids, and that's a lot harder than my job, but that's not considered professional time according to the IRS. So if she's not working in any other job and she spends 15 hours a week working as a realtor or working as a property manager for herself, then she can achieve real estate professional designation. And that's great if you own property that you're getting tax losses, especially depreciation, accelerated depreciation out of. If you're a rep, a real estate professional, you can deduct depreciation that comes through from other syndications that you're invested in, as long as a couple of things have to happen. As long as it's an LLC interest and not a limited partnership interest. I know in the real estate syndication world, we use LP interchangeably, even in LLCs. We say, I'm an LP investor, meaning you're a passive investor. The actual legal structure of the entity matters big time for the IRS. If it's structured as a limited partnership, so ABC Investments LP, and if you're a limited partner and a general partner, you can't take those losses. If it's structured as an LLC and you qualify as a real estate professional, you can potentially take those losses. We have clients with investments in 30 or 40 syndications, and they're taking all of those losses from those K1s against their active income. In order to do that, though, you still have to materially participate in an activity. And again, I'm going to go into more detail about material participation in a little bit, but you have to materially participate in at least one real estate professional activity. Real estate professionals have this really cool allowance that they can be passive in a bunch of other real estate professional activities as long as they have one activity, like they run their own single family rental and they manage it, and that's their house. Then if they're a material participant in it, then they can elect to group all of their investments in other real estate syndication LLCs in the same bucket for the test of whether they materially participate or not. I think that's pretty awesome. We have a lot of clients and taxpayers I've seen take advantage of that. So I want to talk about passive tax advantage investing, even if you can't get it to the active bucket and take the losses that might come out of those against your active income. There's still a huge advantage in investing in tax optimized investments. Any investment that not only provides positive return, you should never let your tax tail wag your business dog. Focus on finding the right investments that underwrite well, that are going to make you money and grow in value. And then if you have two that are equal and one offers more tax advantage than the other, then that is going to increase and improve your ROI over the life of the asset. If it's really tax advantage and you can get it into active bucket in first year, you get immediate ROI of 20, 30, 40%. We've seen some real estate syndications or car washes get people 60% ROI in the first year without even generating any operating cash flow distributions from that entity. If you can't put it in active, a common one again in real estate, and I know we don't want to just talk about real estate, but it applies to a lot of different sectors. If you're getting allocated in this partnership or syndication you're invested in, if you're getting allocated accelerated depreciation or any other tax losses, and you can't use that to offset your active income, if it's the first passive investment that you're in, you get to keep that loss. It just rolls over as a passive activity, a loss carry forward. So in year two, as it starts spinning off cash flow distributions, you have this big loss to offset any income that's allocated to you from that property until you use up your passive activity loss. So generally in multifamily housing, you see people get, if it's their first investment, they don't get to use their operating loss that year. It's a passive activity loss, but for the next 5 to 6 years, they're getting tax-free distributions. So compare that to being invested in, I don't know, IBM stock. I don't know if it's paying dividends or not or now. Let's say you put in $100 and they pay you $2 in dividend each year. that dividend is going to be taxable to you at your highest marginal tax rate. You might be able to qualify for the 23.8%, but let's just say you get, to make the math easy, let's say you get $10 in dividend. You're going to have to pay at least $2.38 in tax on that dividend if you're in a high income tax bracket or higher income tax bracket. But let's say you take that same money and invested it in a real estate syndication or a car wash syndication or an ATM syndication, and you had passive activity losses allocated to you in the first year, then that $10 in distribution you get is 100% tax-free. So in the stock, you would actually get less than $8 in a dividend after tax. In a syndication that's spinning off passive activity losses, you would get the whole $10. Add that to your ROI and cash flow forecast that out for the next 5 years and look at the real present value of that cash flow. It's a huge ROI difference, huge ROI, even if it's paying the same amount in distributions or dividends. All of these, the main reason that they're tax optimized is due to depreciation. Depreciation is a beautiful thing, and I'm going to talk about a little more about it just in case you guys aren't very familiar with the concept. But you can get good depreciation allocated to you in an investment that has anything that has depreciable property in it. Dry cleaners is another one. We had a friend syndicate this 2 years ago. Turns out dry cleaners are very equipment intensive, and they were able to get huge bonus depreciation out of it. Bonus depreciation is phasing down, at least currently. I'll talk more about that when I get to my bonus depreciation slide. But it's still, even before we had bonus depreciation, we were still doing accelerated depreciation through cost segregation studies many years ago. And it still might not be the biggest bang for the buck in the first year like it was last year, but it's still a pretty darn big bang for your buck. Again, I mentioned oil and gas. It is a tax advantaged investment. Oil and gas, there's 2 ways you get deductions for it. Again, if you invest through it without liability protection, like as a general partner in an LLC, if you invest in it, you get to take all the losses that it generates, usually in the form of IDC, intangible drilling costs. That's the cost it takes to go and drill a well. And usually in most oil and gas funds, you see anywhere from, on the low end, 65% of your investment in the first year up to 85, even 90% of your investment being used up for IDC, intangible drilling costs. That is a deduction that you can offset your W-2 income, your physician income, any of your active income, or if you don't have active income, you can offset your portfolio income as well as passive income. It's a beautiful, beautiful deal. And then after you use that, you get something called depletion, percentage depletion. So for every $100 of dividends or distributions it pays you in the future, you get a 15% write-off right off the top every year, always. As long as that investment continues to spin off cash flow, you get $100 in cash, you only recognize $85 in income. It's very tax advantage. Again, consider how you would cash flow forecast that out, doing your present value calculations. It increases your IRR tremendously over the years. Now we talk about depreciation, which I think is one of the most beautiful things in the world. It is a magical deduction, and we've gotten to see a lot of it through bonus depreciation ever since 9/11. Depreciation is a concept that the IRS says anytime you have an asset that you use in a trade or business that has a useful life of more than 1 year, you're not supposed to write it off immediately as an expense. You take it as a deduction over the useful life that the IRS says that asset has. So to make it really general and simple, let's assume I'm a cab driver. I buy a $10,000 cab, assuming I'm going to take straight line depreciation. The IRS says, hey, that cab is not, you can't expense it all now because it has a useful life of more than 1 year. The IRS says automobiles have a 5-year useful life. So in theory, if I spend $10,000 on this cab, I get to deduct $2,000 per year for 5 years until I've recovered all of my costs. That's the very basics of depreciation. But we do have this thing called bonus depreciation, which has been a boon for our economy. The first time it came about was right after 9/11. You guys might not remember, but the economy took a big hit. There was a big slowdown in the economy after 9/11. And Congress was working together. They actually have done that once in a while, not a lot lately, but they worked together and they said, hey, we need businesses to invest and grow our economy. We want them to grow their businesses. We want them to hire more people. We want them to buy more stuff. And let's come up with this idea and see if it works. And it only was good for a year. I think, maybe 2 years the first time. And they said, any asset you buy that has a useful life for more than 1 year or longer, you can deduct in that year, it was 50% of it immediately. The rest you can deduct over the rest of its useful life. And purchases from businesses, business spending went through the roof and our economy took off. It was pretty amazing. And that wasn't the only reason our economy took off, but we had one of the biggest shocks to our economy since the Depression in the 9/11 event. And the economy recovered in 1 quarter. And a lot of that was attributed to bonus depreciation. Well, it expired a year or two later. And guess what Congress did? They immediately put it back into effect. It expired again. And this time they came up and put it back in effect even bigger. I think it was 70%. I think it did expire 1 year. Congress couldn't work together and the White House wasn't working with Congress. I think there was 1 year where we didn't have any bonus depreciation. But after that year, it came back in force. And starting in 2017, all the way through 2022, we were given, in the Tax Cut and Jobs Act of 2017, we were given 100% bonus depreciation. And it caused businesses to spend a lot more money because they got a bigger bang for their buck and they got the tax advantages for it. In the Tax Cut and Jobs Act, 100% bonus depreciation had to be slated to start winding down after a certain period of time because of the way they passed this law through reconciliation. They didn't want it to be able to be filibustered in the Senate, so they had to come up with COB numbers that said, hey, you can't spend more than $1 trillion net without putting it up for a vote and allowing filibuster to happen in the Senate. So they had it start expiring. So we got 100% bonus depreciation for 5 years, 2017 through 2022. And then it starts going down 20% per year for the next 5 years, starting in this year. So bonus depreciation 2023 is only 80%. 2024 goes down to 60. In 2024, we have an election, a national election, both in Congress, Senate, and the White House. I will be shocked if they don't restart and reinstitute 100% bonus depreciation. People and politicians of both parties realize that it helps spur the economy. And one thing I do know about the people in Washington, they want to get reelected. It might be the only thing they care about. Regardless, that's good for us and it's good for tax and it's good for the economy. So I suspect it'll come back. That's I'm putting myself out there on a recorded video saying I suspect the future holds more bonus depreciation will be reenacted. With bonus depreciation, there's this thing called cost segregation. And remember, this doesn't just apply for real estate syndication. It applies for any operating business out there, including any business you buy yourself, and including if you go buy a single family residential property and rent it, you go buy and build some storage units. Cost segregation helps you take a bigger piece of deduction through depreciation. It's called accelerating your depreciation schedule. Cost segregation in its basic form is, let's say I go buy a car wash and my CPA just goes ahead and says, okay, you spent $1 million on a car wash. I'm going to put $1 million to the building. It's a 39-year building. We're going to take 1/39th of a deduction of your $1 million each year for the next 39 years. That's how most CPAs will actually act. And it shocks me, but that's how the majority of tax returns were prepared and majority of car washes that I've seen prepared by other CPAs. In that car wash, you have a lot of stuff that's not the building. You have the land. You can't ever depreciate land. IRS says land doesn't depreciate value. Everything else does. So you'd have to back out how much you paid for the land. But then everything else, you have some that went to the shell of that building, but you have a lot that went to the car wash equipment. The majority of your purchase price went to that car wash equipment. IRS says all that equipment has a 5-year life. The parking lot has a 15-year life. All the land improvements have 15-year life. Some of the stuff has a 7-year life, like the furniture in your waiting area. How do you figure out how much of your purchase price should be allocated to all those things that the IRS will let you depreciate much more quickly or take as bonus depreciation? Simple. They've prescribed 6 or 7 methods that are allowable. Most good cost seg specialists or engineers use a hybrid of those models. It's completely allowable. It's completely legal. They go do an engineering-based study and pull out and say, okay, of the $1 million you spent, 600,000's on the equipment, hundreds on the driveway and the parking lot. And all those things, even this year, are eligible for bonus depreciation, only 80%. The remaining you depreciate over the 5- and 7-year useful life that those items have. So cost segregations are beautiful tools that accelerate all your depreciation. So as I said, any time you want to take take a tax loss and put it in your active income bucket. And that's what most of us professionals are looking for, a way to reduce our active income. Can't do it with passive income or passive tax losses. Can't do it with portfolio losses. I mean, yeah, I can take up a $3,000 a year in a capital loss against my active income, but that doesn't help when if you have a couple $100,000 of taxable income. Even if you have a $200,000 capital loss, that really sucks because you can only take 3,000 of it a year for the next, God knows how many years, 50 years. If you are invested in a business that you materially participate in, you have to be part of an owner, have some ownership in it. You can own the whole thing or part of it through partnership. If you materially participate in it, it's considered active income when it makes income and an active loss when it has a tax loss. So again, we had some clients get in a car wash syndication this past year. They worked out through the syndicator way where they could actually manage one of the properties, one of the car washes that were near their house, near their office. We worked hard with them to make sure they did qualify as material participants. Well, guess what? Their depreciation, in this case, that car wash had, for each $100,000 they put in it, they got $120,000 of depreciation that year. They were able to use that as a tax loss to offset their active income and their W-2s and other professional income. So material participation is awesome if you can do it. What does it take to do it? Well, actually, let me back up. It's awesome when you have tax losses. It's not always awesome if you have taxable income and can't offset it with something else. If you materially participate, this is where the IRS, they don't want you to have your cake and eat it too. So yeah, we'll let you, the IRS says, we'll let you take active losses if you materially participate in the activity to offset your other active income. But if you have income, that's active income, meaning it's subject to payroll tax. It's subject to FICA, Social Security, and Medicare. So it's not always good to have active income because then it's tax disadvantaged investment. In most cases, material participation, active versus passive status, is a year-by-year test. So if you structure it right, you have an active loss by materially participating in an activity. And I'm going to give one example here in a second. In year one, but in year two, it flips over to passive and you don't materially participate in it. So as it makes taxable income because you accelerated all the depreciation in it, you don't owe self-employment tax. It just flips over to passive income stream. It's not always the best thing to do, especially if you have a lot of other potential investments that are going to come into the active bucket. You want to have them grouped together for a lot of different reasons, but it's something you can manage. You just have to actively, proactively manage it. Use the tax code in your favor, and don't be a victim to it by not realizing, oh, next year I'm actively participating. Darn it, now I have to pay an extra 7% in taxes on it. Short-term rentals, again, is a beautiful thing. I know I've already talked about it, but anyone can do this. And short-term rentals, generally speaking, if they're run well and by educated people who did their homework, vacation rentals have a much higher rate of return than single-family residence or most long-term real estate and most commercial real estate. Our average STR client, and we haven't actually run all the numbers, but I feel pretty confident in saying their cash on cash return in their full second year of being in operation is generally somewhere between 15 and 35%. That's a lot higher than we're seeing other real estate, commercial and multifamily residential and single family residential going. So it's a great cash flowing business, but you can also qualify as a material participant. The IRS explicitly states in the Treasury regulations, any property that you rent that has an average lease length of less than 7 days or less during the tax year is not a real estate professional activity. So it's just a normal active trader business. Well, if it's a normal active trader business, you don't have to worry about real estate professional. And all you have to do is materially participate, and boom, you get that accelerated depreciation schedule, offset your active income. We had a lot of cases in the last few years where the bonus depreciation on a short-term rental more than paid for the down payment that our clients made to buy that property. So that's tax advantage investment for you right there. You get an asset that's producing income, growing hugely in value, and the IRS subsidized it. It gets no better than that. That kind of stuff makes me think taxes are just beautiful, man. So how do you qualify as a material participant? There's 7 ways to qualify. I like to focus, if you know you want it for losses, I focus on the top two that I call the gold standard, the bronze standard. The gold standard is any activity that you spend 500 hours or more in a year. Boom, you're by default safe harbor a material participant. Cool thing with material participation, especially compared to real estate professional, spouses can combine their time. So again, back to the short-term rental world, we had a married couple, they were putting together IKEA furniture in their new Airbnb they bought. They spent 10 hours a day for a couple of days each. The wife got 10 hours, the husband got 10 hours. So even though they were spending 10 hours a day together, they got 20 hours a day to count towards material participation. So any effort, any time you spend to grow that business, to improve that business, to manage the business, to add value to the business will count towards material participation. If you get 500 hours, you don't have to worry about what anyone else does. You are good. If you have a bunch of different smaller businesses, but they're similar type business, again, Airbnbs, you have 5 properties. You can spend, as long as you spend 100 hours in each property and combined you spend 500 hours, you're still by default safe harbor material participant. Doesn't matter if anyone else is doing anything. Specifically in the short-term rental world, I've seen podcasts and heard webinars and even read articles where they say, if you have a management company, there's no way you can qualify for material participation. I categorically disagree with it. If you have a car wash and you have management on site and you spend more than 500 hours a year managing the manager, looking over the financials, providing guidance, you are a material participant, even if you're not the one running the store. Same thing with short-term rentals. If you hit that 500, great. That's the gold standard. If you don't hit the 500, you can still qualify for material participation with 100 hours. But you have to spend more time than anyone else. So you'd have to spend 100 hours and more time than anyone else working on there. So again, if you have a car wash, you don't hit the 500 hours, you got a manager working 2,080 hours a year there full time, you're not going to qualify. But if you hit the 500, you can. But if you have short-term rental and you spend 110 hours a year on it, and your cleaners only spend 60 hours that year cleaning it, you do qualify for material participation. And you can qualify as material participation in all types of syndications. Just talk to the GP, talk to the syndicator, and let them know that that's something important to you. How can you add value? And not only is that good for tax, you also get transparency and insight into what's going on with your investment. So I think it's a great option. If you're going for material participation, I highly, highly recommend keeping a very detailed contemporaneous time log. It sucks. Most of my clients complain to me, call me a time Nazi or an hour log Nazi. But if you get audited and you got a great benefit from claiming material participation and getting an active loss to offset your other income, your get out of jail free card is a very good, detailed, contemporaneously taken time log that shows what you did, when you did it, with as much detail to help you be able to defend to the IRS. You really did that. You didn't make this up. And I also strongly recommend keeping it in very small time increments, either in 5-minute increments or 1/10 of an hour, 6-minute increments. Track it. There's plenty of apps out there for time tracking. Definitely something I would highly recommend. Okay, out of material participation, tax credits are, like I mentioned earlier, they're much more valuable dollar for dollar speaking than tax deductions. This past year, when they passed the infrastructure bill last fall, they increased wind and solar and alternative energy tax credits to 30% of your investment. At first I read, I didn't think it was that big of a deal, but then I realized I was hoping to buy a short-term rental last year. The interest rates went up too high. I thought property values were too high for the interest rate I'd be paying. So my wife and I pivoted and said, okay, no short-term rental. And we realized we had a big tax problem before the end of the year. So I read this new tax bill that came out, I think it was September. I said, okay, I don't really want solar panels on the house, but let me go look into it and see if there's any way I get a 30% credit. Turns out, or just residential, your own house, you can go get solar panels, and most solar companies offer crazy incentives. Like in our case, we got the whole thing for 1.9% interest, no cash down, no money down, and amortized over 25 years. So we put $100,000 of solar panels on the house. I grant it, don't let the tax tail wag your business dog. I put a lot of time into comparing my utility bills, looking at the history of how often and how much, historically speaking, do power bills increase year over year. I built out a 30-year cash flow forecast and present value forecast. And I think ultimately it's going to save me money on my power bill. I'm paying less for these solar panels and the installation than I would be paying for power over the next 25 years, considerably less. And I only paid, and we got them, it's perfect timing for taxes, and I can't take credit for that. But they got those solar panels up on December 21st. My first payment for them wasn't due until January of 2023, this past month. And I got a $30,000 tax credit from these things. No money down. It's a beautiful credit. Granted, it's only a one-time credit, so you want to make sure your investment pans out. I suspect, I haven't seen any yet, but I've talked to a lot of syndicators and said, why aren't you going out and building wind farms and solar farms? Because you could pass this 30% credit down to your investors. You could highly leverage it. A lot of them are looking into it. I'm sure there's a way. If I can make money or save money by putting panels on my house, I suspect someone that's running as a business can sell electricity cheaper than it costs them to make it with solar panels or wind. If you invested in a solar or wind syndication, and there's some other alternative energy too, you could get that 30% credit passed on to you. If it's leveraged, you might put in $100,000 and get a $250,000 credit. It's very possible that could happen. So I would be on the lookout for those. Be shocked if we don't see some of those investments coming out in 2023. There's some other credits, electric vehicles, including hybrids, that got increased. Hybrids are allowed now. Used electric vehicles give you a credit. Those are some good credits out there that can offset your active income. Well, actually, it offsets your tax bill, regardless whether it's from active, passive, or portfolio. Research and development credit. You have to have a business that's operating to get it, but it's a huge credit. It's very underrated. I've seen so many businesses that are eligible for it, never even think about it. We don't know how to do the research and development tax credit. You have to have a serious engineering background to even figure it out and follow that tax law. I understand how it works on tax return, but I can't go figure it out and be aggressive. But I found some awesome tax credit specialists that have engineering backgrounds and legal backgrounds, and 2 out of every 3 businesses that go to them that never heard of the research and development credit end up getting a very large credit. And a lot of types of syndications out there are eligible for it now too, and no one's taking it. So if you're in a syndication, talk to them about R&D. Generally speaking, unless if you're in multifamily housing, there's probably not an R&D credit unless they're building it. But if they're building it, you're doing a new build syndication, there is R&D available there, guaranteed. Hardly anyone takes it. If you're in some other type of syndication, there is R&D in car washes. There's R&D in restaurants, pretty big R&D in restaurants, surprisingly. There's over 100 different common tax credits available, many more that are less than common. But no one's thinking about looking at them. Learn those, figure out what you're doing, talk to your CPA, press them. Hey, tax preparer, these are the investments I have. What kind of tax credits could they be eligible for that they don't know about? And I need to come tell them. Press them about your investments, your business. We have physicians' practices that are eligible for the R&D credit. We have physician practice that are eligible for the work opportunity credit, the employee retention tax credit. There's so many credits out there, and it's basically free money and dollar for dollar reduction. So look into it, push into it, use the tax code for your advantage. Don't be a victim to it. Another important tax planning concept is what I think other people call it too, surfing the tax brackets. Again, not with your W-2 and probably not much with your 1099, but most other streams of income, you can decide when you recognize that and either choose to defer it to the next year. I had clients taking out money of their 401k. They were in a high tax bracket this year. We knew they were in a low tax bracket last year or next year. So in 2022, in December, when they came to us and said, hey, I want to take out 200,000 of our 401k, we did tax planning, and it made no sense for them not to wait until January 1st and at least kick the can down the road. Even if they have to pay the same amount of tax next year, they got to keep their taxes for a whole extra year. They can make money on that, time value of money. But in this case, we know their taxable income, therefore their marginal tax rate is going to be lower next year, much better recognized income next year than this year. Likewise, if you have a low year, you do have some great tax opportunities that you're taking advantage of and reducing your active income and getting yourself down low or even to a negative tax or zero tax. That's the time to trigger income. Especially with real estate professionals, but anyone who's able to get their taxable income down low, get them in the lowest tax bracket, 10%, 12%, or 0% tax bracket, should always consider converting any retirement money you have at that point into a Roth IRA or Roth 401k, preferably 401k for a lot of tax reasons. But the difference between Roth, I'm sure you guys know, I don't want to belabor it, but Roth IRAs are so much better to have growing for you than regular 401ks or regular IRAs. They grow tax-free, but when you take the money out after you retire, they're tax-free. There's no required minimum distributions if you don't need that money when you turn 65 or 64 and a half. So consider, you can convert Roth. All it does, you're converting a regular retirement account into a Roth retirement account. The only thing you're required to do is recognize income for the amount that you're converting. If you get yourself into where you have a negative $100,000 taxable income in a year, convert $100,000 tax-free. You're moving it over. And that just allows your money to grow that much more tax-free, and then you take it out tax-free in the future. So another big one that I see missed too often. And George, that's what I have for you guys. Hopefully you guys have some follow-up questions on some of this.
I can't imagine that we would not have tons of questions for you. This was super awesome. Thank you so much, Mike. I'm going to allow folks to get their questions in the chat box while Bio kind of bird dogs that. I'm going to just kind of come out with a very general question because of all this information, and it's kind of just so overwhelming. One question I had is, how do we go about identifying the CPAs who understand this? Whether, like you said, we need to press our current CPAs, but what if we decide and identify that they're just not up to task? And now we start looking for other, CPAs, other professions. What best in class strategies can we use to identify good CPAs?
I mean, it's not the worst thing to have to go press your CPA. If they know, if they know the law well, and they know you well, it's important your CPA knows you well and you have a good working relationship. It's not the worst thing to have to press them and get them to think. And sometimes once they learn it, they realize, oh, there's a lot more we could be doing with you. But I think the most common denominator with proactive tax CPAs versus reactive ones that only really are just glorified tax preparers. They take your numbers from the end of the year. They don't meet with you or talk to you until January or even later, and they take your numbers and put them on tax return. They're not doing any tax planning. If they ask to meet with you, if they're offering to meet with you during the year, when there's still time to change your tax footprint, then they're probably kind of proactive with taxes. So I would say start that question off. If you're interviewing a new CPA, hey, do you do tax planning? How often do you do it? And give me some ideas of what we can do. If they don't have anything for you and they're like, no, we really don't need you until the end of the year, until it's tax preparation time, then they're probably not very proactive. Ask them. Anyone who's read Tom Wheel right knows how much of the tax code does not involve the levying of taxes. Ask them, hey, in the tax code, on your knowledge of taxes, how much of what you know can reduce my taxable income and reduce the taxes I have to pay versus having to pay taxes? And if they say, well, there's really not much, there's your answer. But if they get excited about it then and want to start talking with you and start boring you with all kinds of Internal Revenue Code citations, then they're probably pretty good at it.
Yeah, I want my CPA to get excited about that question for sure.
It is exciting.
Two questions. So thanks, Mike. So the first question, this is from Kamina. It says, please repeat what it means to ensure that oil and gas investments need to be structured correctly in order to take advantage of being able to offset active income.
Yeah. So the Internal Revenue Code section 469, that dictates what's passive versus active, mainly in the losses area, or in tax losses versus, tax losses for passive versus active. It says oil and gas working interest has to be a working interest. It can't just be an oil and gas. You're going and buying a piece of land to eventually develop in a few years and turn around and sell to someone before it gets developed. It has to be someone that's actually trying to drill and pull out oil or gas or energy from the ground and sell it. So it has to be working interest. You cannot have any liability protection. So if someone's offering you to invest in oil and gas through a limited liability company, and a limited liability company, one of the main reasons they use it is each member is liability is limited to the money they put in it. They have good liability protection. There's a corporate veil there. If you have a corporate veil of protection in the year that you're hoping to get a deduction, you can't take it as an active loss. It's passive for you. So the way most oil and gas interests work, I mean, they're very, very aware of this rule, and that's what gives them a higher ROI for their investors than other investments out there. Most of them realize this, and most of them set themselves up as a limited partnership, but they bring you on as a general partner. Your first year you make the investment, you invest as a general partner. Once you get your intangible drilling costs allocated to you, generally soon after they issue their K1s in that first year, assuming they've used up all their IDC, it might take 2 years. They usually convert you then into a limited partner. So you have general liability as a general partner in that first year, but it allows you to take the deduction. It's risk versus reward. You are taking some risk, but you have the reward of deducting that. Just make sure it switches to an LP and stay after the oil and gas operator that you're invested with to make sure it turns an LP as soon as you get the benefit of your taxable income. That's the main thing you have to be careful of, and just make sure you speak with a good tax attorney or tax advisor before you sign on the bottom line of the PPM or the operating agreement to make sure you understand, is it going to qualify as active loss for you? And you ought to talk to an attorney too, to make sure they read the agreement and know that it's going to turn you over and to have some kind of corporate veil of protection once you've enjoyed the tax benefits of IDC and depreciation.
Yeah, thanks, Mike. So
You
that's
bet.
the kind of structure we had in the King Operative deal for the oil and gas. So you have to be general partner, so which exposes you to some form of liability in your first year, which is the most uncomfortable part of it for most people.
Yeah.
But that is the reason why you get a tax deduction. So it's kind of a double-edged sword in that case.
Yeah.
So the second question, for real estate asset protection, do you side with one LLC per property or one LLC for different property? Although this is going towards the law part, but tell us your opinion about this.
Yeah. So I have to provide this disclaimer. I'm not an attorney. I'm not licensed to practice as an attorney. I'm not allowed or even qualified to offer you any legal advice. You should always consult with an attorney regarding anything involving legal liability. And asset protection is all about legal liability. There are some tax attributes to it. You want to be careful that they don't provide, your lawyers don't give you this awesome asset protection and take away all your tax benefits of your investments. But I'll tell you what most of our clients' attorneys tell them. Again, please consult with an attorney. Don't take my advice as legal advice. It isn't. Most of them start with one LLC per property. And the way the lawyers have explained it to me is, if you have an LLC that gets a lawsuit attached to it and the jury finds in whoever's suing you's favor, they can potentially take anything that's in the LLC that has been operating that property. So that's why most people start off with separate LLCs for each individual property. But that also turns into an incredible headache. If you're growing, and hopefully we're all trying to grow, and if you're trying to grow, then your portfolio is going to grow. And if you have in 5 years 20 LLCs with 20 bank accounts, because you're not allowed to commingle income or expenses or accounts between one LLC to another and still keep their corporate veil of protection siloed off, they end up, if they're commingled, they can all of a sudden all be attached in a lawsuit. So if you have 20 bank accounts, 20 LLCs, it gets a little bit crazy. There's a law firm that I've been working with now for a year or two, called Trust Day. Kevin Day wrote a book on some incredible asset protection. It doesn't make sense until you get to a certain level, because it's expensive. I think it's like 25 or 35 grand to put into service. But you can actually just have one LLC to own all your property. And then they create this foreign trust. It's an irrevocable trust, and they use it the Cook Islands. I think it works in a few other places, but they love the Cook Islands for a lot of really cool reasons. You should try to get him on your show if you ever can for asset
Definitely.
protection.
I'll be reaching out to Kevin.
Yeah, let me know, George. Let's meet together.
Yeah. So you've got all of your assets in one LLC, but you have a foreign protection trust, and then they do things with like filing liens to where you have all of your assets, but you have zero equity. And if anyone sues you, they can't get anything from you anyways. And it makes the accounting side and the tracking side and just the logistics of not having a million LLCs with a million different bank accounts. You can put it all in one, but that gets pretty expensive. I'm starting off for every one of my investments that potentially has liability under my attorney's guidance, a separate LLC for each thing I do.
I think that's usually the way to start. But now, like you said, I have so many properties now, and I started grouping them actually. If they have the same kind of risk profile, like you have like few, 4 units here, 8 units there, 8 units there, class C, just put them together and then put another property to class A, so you could start putting them together after a while.
Yeah, I agree. Same advice I was given. It started getting out of hand, and then they told me to just get like 3 or 4 and then make a new LLC, just so you can kind of limit all that administrative work. But you try to make them similar, in asset class type, that you put in the same LLC.
Yeah, great mind thinks alike, huh?
Yes.
New one. Can you offset capital gain from real estate property sale with capital loss from stocks?
There is actually ways to do it, but you have to plan ahead of time and make sure you're not grouping that real estate property with your other real property. You still have, if you have depreciation recapture, you got to recognize that first, but there are ways with stock to offset capital gain. As long as it eventually flows through as what we call Section 1231 gain, it's reported in the same form and on the same schedule as your stock sales are. So it's possible. It's aggressive. You need to understand the risk versus rewards, and you need to plan ahead of time and make sure your previously filed tax return the year before, at least, if not a couple years before that, is correctly lined up so that you can take advantage of this when it happens.
So you can, that's actually quite impressive.
Yeah, don't get me wrong, it's not easy to do. And we have a lot of clients that we can't do it with, but if you plan ahead of time and if the stars line up right, yes, you can do it. Generally speaking, you've got your real estate activities in that passive bucket, passive income bucket, and your stock sales are in that portfolio income bucket. So you're not supposed to cross back and forth except with active losses. So you have to be careful, but it can be done.
Do you have to qualify like an active trader or no?
That can work in some cases, very limited cases. But if you are an active trader broker and you're an active real estate, then all of those can get combined together. If you're passive, if the real estate's passive and you're an active trader, then it's still possible. It just gets a little harder. It just depends on your actual facts and circumstances. Everyone's a little bit different in that area. We've done it before with non-real estate professionals, but they had special circumstances that made it doable.
Okay, thank you very much. How about midterm rental tax considerations? Can you get reps from midterm rentals?
Yes. So midterm rentals generally are like 30-day rents or 60-day rents. Those exceed the 7-day carve out. So they're still considered real estate professional activity. And yeah, you can qualify as a real estate professional by managing midterm rentals. You can't use the material participation and not qualify as a rep and take losses from midterms. The only way to take a loss from a midterm in your active income bucket or active loss bucket is to qualify as a reps. But the time spending managing midterm rentals can qualify. This all comes down to 7 days or less. If it's 7 days or less average lease during the year, and that's all of your leases added up and divided by the number of leases you had, if it's 7 days or less, it's not a real estate professional activity. If it's more than 7 days, it is a real estate professional activity.
Okay, thanks. And the last questions also borderline some law. Do you recommend sole ownership for rental LLC or more than one owner, like your like non-spouse, to maximize tax deduction?
Like you mentioned, a lot of that is legal, so I can't offer the legal advice on it. From a tax perspective, though, there's no difference, except if you have a non-spouse owner partner in an LLC, they're going to get half of the benefit if they're 50-50 or whatever their percentage is. If it's a short-term rental or some kind of operating business, then it might be hard for two partners that are not related to both qualify for material participation. Again, we've seen this. We saw it one car wash 2 years ago. We saw it in a bunch of vacation rentals this year, where two people, like two brothers or two sisters or just some friends, went and bought these businesses together, put them in an LLC, and none of them spent more than 500 hours managing that business. So because they couldn't get that gold standard of material participation, we were shooting for the 100 hours plus more than anyone else. So then you had the two partners working against each other because one of them was going to work more than the other, and they were the one to get that benefit. So from simplicity's sake, for tax purposes, I would say single member LLCs work perfect in most cases.
I'm going to, you answer most of the questions we have, oh, okay, there's one. Hold on, let me see. Well, let me see what you have to say about this. What is the minimum age to start your kids on a payroll? I have kids aged 4 to 7, and my CPA say they are, let me see. My CPA say they are too young.
It depends what you want to use those kids for. So there's no minimum age requirement. You just have to get through the smell test or the legitimacy test. Is it a legitimate job? Are you paying them to do something you could pay someone else to do or would pay someone else to do? And are you paying them reasonable rates? So we have one physician that went way on the aggressive side with this. He's a good friend of mine. He insisted on it. And so he hasn't gotten audited. So I think we're okay. I think the statute of limitations clicks here in a couple of months. He paid his newborn infant as a model to take true professional photos. And he took those photos and he put it up throughout his practice. And he paid that infant $10,000. He took that as a deduction on his tax return. And he created a Roth IRA for the infant because the infant now had earned income and could contribute to a Roth IRA. It was beautiful. I think that's pretty darn aggressive. Although he went and got comparables because he wanted infant pictures of really beautiful ones in his office. And he did go get quotes from other people that provided similar artwork. And he made sure to pay his infant less than those quotes he had. So we do have some basis and be an interesting argument. I think it's 51% chance he prevails on that, but a big 49% chance that he might not. Now, I have a 6-year-old son, and I started paying him this year to shred paper. And I'm paying him $25 an hour to shred our client paperwork here in the firm. We have to shred those. I think I can pay more than average minimum wage because it's a pretty important job. I need to know that someone's not going to steal that documentation. They've got good credibility. Granted, I supervise him when he does it, but I think if I were to find another professional to do that, I would have to pay $25 an hour or more to find someone at a level of character that I can trust with my client sensitive documents to shred it. So when it comes down to you can pay any age child as long as they're doing legitimate work. I spoke to another client just the other day on this exact question. They've never done it, but they've got kids. They live on a farm. Their kids take care of the chickens. They do everything, feed them, clean the coops. They get the eggs. They bring the eggs to the stand at the front of the house where they sell these eggs, and eggs are going for a lot of money now. So these kids are making that family a lot of money. So we looked at and said, okay, you can pay them half of what you make and on the eggs. And they're making a lot. I mean, we want to keep it under $12,000 a year because this year that's the limit before they would have to file a tax return. But you could pay them and they're creating profit for the family. And the parents don't have time to do this. They both have full-time jobs. So that's legitimate. So as long as it's a legitimate job, it's fair. Granted, the older they are, the more legitimate jobs your children can do. So the older, the easier it is. But it's a great idea. Don't forget that Roth retirement accounts are awesome. But as a child, unless you have earned income, you can't contribute to a Roth IRA, a Roth retirement account. But if you have earned income because you're doing this tax planning, then that child can contribute to a Roth. And if that kid has money growing tax-free, if you give a 7-year-old $6,000 a year in a Roth retirement account and let it grow until they turn 65, that money's going to grow tax-free, come out tax-free, no RMDs. They are going to be set for a pretty decent retirement, all because of you helping them each year, starting off now. So I think it's a great idea.
Okay. I'm going to follow that up with an audit question and also one last question before we round up. We're at 5 o'clock. So what is the worst case scenario involving audits, or can you talk to us, because we would like to, because that's one of the things that we're always worried about, because like we talk about conservation easement a while ago, And most of the issue is, everybody's worried about, being audited about that.
Yeah.
And, so what's your take?
I mean, as long as you aren't breaking the law, the worst that's going to happen is you're going to pay the taxes that you saved back, plus some penalties and interest for paying them late, basically. Again, it's a big gray area. As a tax preparer and register with the IRS, we're allowed to sign and file a tax return as long as, in our professional opinion, we have a more likely than not belief, and we have to have that based on reasonable belief, that we would prevail in an IRS audit. And we'll never file a return that has less than a 50% chance of prevailing, or less than a 50+1. And the really worst case with our clients are unreasonable IRS agents, because most CPAs or tax attorneys will charge you by the hour to defend you from the IRS. Hopefully, most cases, we can get that audit shut down pretty quickly or come to a quick agreement. But some of the worst case scenarios are, we have, for lack of a better term, Nazi IRS agents that don't know the rules, and they insist on continuing to fight things that we have to continue to prove to them they're wrong over and over and over again. The worst case audit I've defended a client in, I think we ended up billing them over 150 hours, and it should have been put to bed in 10 hours. So that's the worst case, I think. Now, if you're cheating, I mean, it's possible you go to jail. That's how Al Capone went to jail. He wasn't reporting income for many years. They couldn't catch him on all the criminal stuff he was doing, but they caught him for not filing and reporting his income from all the criminal stuff he was doing. And he went to jail or in prison for that. But just don't cheat. Just make sure you understand. I would say work with your tax professional to make sure you understand, and he explains or she explains to them the risks that you might be taking and what the potential burden is, what it could potentially cost you. And try to avoid what they call substantial understatement penalties. You can avoid that if you work with your CPA. That could make your penalties a lot higher. But generally speaking, it's just interest and penalties and the saved taxes that you would pay. And interest and penalties, generally speaking, run about 1% per month, a little under 1% with the new interest rates. But figure 0.8% per month of the taxes you saved is what you would pay in interest and penalties. But hopefully, when you're working on your return with your professional, you guys are preparing an audit defense file. Not a lot of work is going to need to be done. If the IRS comes to you and sends a letter and says you're under audit, hopefully that file is already prepared, and your professional can just cut certain pages out of a PDF document that's already been prepared, send it to the IRS, and close the audit. I mean, I would always expect to be audited and always plan for it and be ready for it, so you don't have to lose sleep if it happens. And specifically on the conservation easement, we know that the Treasury Department, I think now they're up to 600 attorneys that they have focused on trying to get these conservation easements where they're doing leveraged ones. 100 grand gets you a $500,000 deduction. They're trying hard to fight it, but they keep losing. That's why they keep adding more attorneys. So if you've done it and it was accepted, and even the IRS says it's legal, we just don't think it's following the meaning and the intent behind the law, you're not going to get hit hard on one of those right now because everyone's doing it and it is legal. I just don't know how much longer it's going to be legal, but I wouldn't lose too much sleep over that if you've done it, as long as you did it with a reputable firm that had a reputable CPA or tax lawyer prepare their return, and they have authority for what they took.
Hey, to your point about kind of preparing to get audited, you mentioned kind of the best strategy that you can use is to document and using some specific technology and apps. I wanted to share some of those with everyone. Were there particular ones that you favor over others?
Well, for material participation and real estate professional, I like Clockify and Toggle. Those are two timekeeping apps. I think they're great. Reps is pretty good. I prefer Toggle and Clockify because they track it in one decimal point of time. Expensify for taking pictures and filing your receipts, or if you're using QuickBooks, so you have documentation of everything you've spent, that's helpful. Mostly, like, you just consider any tax position you're taking, kind of like your medical charts that you guys keep. A lot of the reason, sadly, the true reason is that you're keeping so many notes and doing so many copious processes and procedures in your charts is for medical liability protection. It's just required. Do the same thing for tax. Just the more contemporaneous documentation you have that supports your position, the easier it'll be to defend when the IRS comes and tries to take your very legal and well-earned position away from you.
And then one really clutch gem that you told me on our call was also to use those apps to document your own physician clinical time.
Yes.
Kind of not just your real estate time. You need something to actually compare it to. So
you only need that when trying to achieve real estate professional status, because you have to spend more time on real estate professional activities than your other professional activities. So if you're trying to achieve rep status, then you would want to track your physician time as well. And yes, if you have your physician time tracked in detail compared to your real estate time, and you definitely have more time on real estate, it's going to be so easy to get the IRS to back off if they challenge your rep status. But if you're not going for reps, you're just going for material participation on any other trade or business, then that's not necessary.
got it.
Perfect. So
We have one more question. Yeah, I see that.
Yeah.
What is a reasonable salary to pay yourself as an S corp? That's what is reasonable. So with an S corp, you get to mitigate your self-employment or payroll taxes. You only have to pay payroll taxes on what you pay yourself in W-2. IRS says you can do that as long as you pay yourself a reasonable salary. Reasonable starts off with, what is a comparable salary someone else would get paid with your same credentials, doing the same job that's not owned for a company that's not owned by them? So what would you make going and working for someone else doing that? Or what would someone else make if they're working for you doing what you're doing? That's where the IRS starts. But then if you own a business, you have lots of other areas that you can explore. It's a first-year business. You don't know how much money you're going to make or not. You need to protect cash and save cash for the continuity of your business, so you can pay yourself less than comparable. You're taking the entrepreneurial risk of starting a business. You get to pay yourself a lot less, and the IRS will agree with that. In down years where you have very cyclical income, again, you need to protect cash. In COVID, a lot of our S corp taxpayers reduced their W-2 income, some for good reason, economic needs, most because they didn't know how much money they were going to make and when they were ever going to make money again. So they lowered that. And we had many filing W-2s of like $5,000 for the year of 2020 or 2021. And we did have one audit. Well, it wasn't an audit, it was a challenge, a letter. The IRS said, hey, this is not reasonable. And we just prepared a one paragraph saying, yes, it was reasonable. We didn't know what was happening and we needed to protect the capital of the company. And they closed that. So what is reasonable is very situational based on the facts and circumstances of every business owner individual.
Awesome. Well, thank you, Mike. We're over time. We want to definitely be respectful of your time and everyone else's time. I think this was an amazing session. We're definitely going to record it and have it available for everyone to review again. I know I'll definitely be reviewing it a couple times. So how can people reach out to you if they want to ask more questions or just get in contact with you?
Just go to our website, pinecocpas.com. pinecocpas.com. I'm sure you'll link it somewhere where the webinar is at.
Doing it right now.
We have a call to action on every single page of schedule a free consult, and click that and you'll get scheduled with myself or my partner or one of our managers. And I'd just like to close with, I mean it seriously, guys. I know it sounds like cliche, but you can either choose to use the tax code to your advantage, or you can choose to be a victim to the tax code. Don't be scared of it. Get excited about it. I see the tax code as the yellow brick road to improved financial freedom. And you can really use it for that. Or you can just be a victim and cut checks.
Awesome. Awesome. Thank you, guys. Thank you, Mike. Everyone have a great evening. We'll be sending out information about our next webinar in 2 weeks. And thank you again for coming tonight.
Thank you, guys. It's a pleasure to be here.
Thanks.
Thank you.